You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by EUREX, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, VSTOXX, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, EUREX stands as the leading European derivatives exchange. Learn more about trading EUREX futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody, welcome to this. This is always a fun time on the network. We have the kickoff of a brand new program. Welcome to the European Market Brief, and a special welcome to all of you who are joining us live here via video. So many of you have been asking us now for 18 plus years, maybe not that much in the beginning, but I would say, let's say at least 10 years. People have been asking us, can you do a little video, give us a little bit of a glimpse behind the scenes? Well, this is a little bit of a glimpse. Things are evolving. As you can see, we're going to do a lot of cool stuff with this space and beyond. Going to do a lot of cool stuff with the video elements, not just of this show, but of clips of other shows out there as well, and a lot of other fun content you can look forward to. So this is just a taste, just a glimpse for all of you who've been asking for years, what does go on behind the scenes? We had the in-person studio for a long time. Obviously, COVID kind of shut that down. So a lot of you have actually on the network side have been in the studio here, but it is kind of fun to give the audience a glimpse. My name, of course, Mark Longo from theoptionsinsider.com. For all of you who are new to the network and new to the program, doing something a little bit different with this program. As you could tell from the title, we're casting our gaze across the pond, looking a little bit farther afield. You know, the notion that people can just start their trading day with the opening bell here in the US and then turn everything off at the closing bell and then rinse and repeat. Those days are kind of behind us. That's kind of an antiquated notion now. We've all seen literal examples just in the last few months of market moving events that happen after US hours, or indeed over the weekend. We just saw that again just this past weekend. We needed yet another example. So it seemed like the right time to have some programming that focused on some developments and some markets beyond our shores. And thus the European Market Brief was born. So special welcome to this inaugural episode. We got some great folks joining me here to help break down all this action going on in the Eurozone. We'll kick things off with Mr. Matt Koren. He is the Equity and Index Derivatives Sales and Global VSTOXX Lead for EUREX. Matt, welcome to this inaugural episode of the European Market Brief.
Thanks, Mark. I'm glad we finally getting to do this. We talked about this for a while, but as you said, the time is definitely right.
The time is now, as the kids say. And you know, Matt, you've been on before on our VolView show in particular, so VolView's listeners may be familiar with all things EUREX, but a lot of new listeners tuning into this program for the first time. At the top of the show, let's give them a quick hit. What are we talking about with EUREX?
Yeah, so EUREX is the largest derivatives exchange in Europe. You could think of us as the CME of Europe. A lot of the products that you may know in the US, we have a European version of. Most of what we offer is futures and options, but we also have some institutional products like repo. With that being said, again, largest derivatives exchange, home to some of the most liquid products in Europe. EUROSTOXX, DAX futures and options, 150 MSCI products, the largest fixed income suite in Europe. And we are also the largest foreign board of trade in the United States. So these are not only European focused products, these are products that are also being heavily traded by US folks as well.
Thank you for that, Matt. And next up is an old friend of the network. He's been on once or twice on programs like Volatility Views. He's also come talk to our pro members quite a few times on pro Q&As. Our good buddy, Mr. Steve Sosnick, who I had the pleasure of meeting in person for the first time down at OIC last week, the chief strategist over there at Interactive Brokers. Steve, welcome to this inaugural episode of the European Market Brief, sir.
Thank you so much for having me. It was a real pleasure meeting you, Mark, in person. You know, it was because we never did this on video. It was the first time we actually saw each other.
Face to the voice that you've heard so many times.
Exactly. So it was a lot of fun. You know, for those of you who are not familiar with Interactive Brokers, we are quite large at this point, self-directed brokerage firm. We offer seamless access to markets around the world, futures, options, bonds, currency, all in one account. And so that's why I think I'm very glad that we can partner on this inaugural episode with EUREX, because we're very proud that we can offer the products that we'll be discussing to all our customers, many of whom live internationally. And so, you know, we really consider ourselves global, and this is a good way to discuss our global footprint. So thank you for the opportunity, Mark, and thank you for the opportunity to the folks at EUREX.
All right, and last but certainly not least, we are joined by a newcomer to the program and indeed to the network. She is Melissa Brown, the Managing Director of Investment Decision Research at SimCorp. Melissa, welcome to this inaugural episode of the European Market Brief.
Well, thank you so much. It's a little tough to be the new kid on the block, but I'm quite happy to be here.
We will ease you in, don't worry. But you mentioned you are the new kid, so we have to start you the way we do with all of our new kids. A quick overview of your background in the world of finance and the markets, as well as this is the first time you've had SimCorp on the network. So what the heck is SimCorp, Melissa?
All right, well, let me start with what the heck is SimCorp. So SimCorp we're a global firm. We're based in Denmark, but have offices all over the world. And we provide front to back investment management systems, our investment management platform. Like EUREX, we're a subsidiary of Deutsche Börse. In 2024, SimCorp and Axioma merged. So Axioma is a provider of portfolio construction and risk management tools. And we are now fully integrated into SimCorp. So I come from the Axioma side of the business. And so my team is really meant to highlight use cases and market implications that we can derive from the Axioma products. So risk models from optimizers and so on. And, our goal is really to help our clients understand the market environments that they are investing in and hopefully help them make better investment decisions, hence the name Investment Decision Research. So you asked how long I've, my other bona fides in finance. So I was a portfolio manager for 10 years at Goldman Sachs Asset Management in the quantitative investment strategies group. And I was a sell side quantitative analyst at Prudential Securities before that. So I've kind of seen all sides of the markets.
All right, got a great group assembled. It is time for our inaugural segment, as you might have guessed from the title of this episode. Listeners, we're going to go a deep dive into the issue of the day. It is time for a continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have continental conversations.
All right, listeners, welcome to our inaugural continental conversation segment, where we deep dive into a particular topic that is particularly germane to the European markets. And this topic is really germane to everyone breathing right now. You can probably guess what it is. It is, of course, tariffs and the trade war, which saw another interesting wrinkle to that over the weekend. We'll get to that in a little bit. But obviously, it's been a wild start to the new year. You don't believe me? Just look at your portfolios, listeners. They've been up, they've been down, sometimes in the same day. We've been seeing wild intraday swings, which for me has been one of the more interesting developments. We're used to volatility before, but these intraday ranges we're seeing even on major indexes like the S&P, 100, 150 point ranges intraday. You have a week's, a month's worth of movement in a few hours, and then you give it all back in the afternoon or vice versa. These are definitely somewhat unprecedented markets. You sprinkle in, of course, something that none of us have really lived through in our lifetimes, which is a global trade war, and then it does become a very much an unprecedented time in the market. So again, making the topic of this show and the focus of this show, the international markets, that much more important because we're seeing so many developments happening beyond the closing bell and the opening bell that are very much germane to our portfolio. So let's get down into it. Melissa, as the newcomer, we will start with you. Obviously, we're in somewhat unprecedented times. Just saw another interesting wrinkle, like I said, over the weekend. But as we look back right now, a wild start to the new year so far. What are your thoughts on the overall impact we're seeing on these tariffs, on the European markets in particular, obviously? I mean, there's a lot of different ways we can look at it. Obviously, you're an economist, so an economic perspective. If you want to sprinkle on a little bit of political as well, have at it. And then, of course, from an overall markets perspective, Melissa.
Yeah, well, certainly it's very difficult to not sprinkle in the political because that seems to be what's
driving force for all of it. Yes.
And, I would also say that, yes, we've had a crazy start to the year. We also had kind of a crazy end to last year. So after the election, I think investors were very enthusiastic, about the U.S. market, about, potential relaxation of regulations, of lower taxes and so on. And so we saw this kind of blowout quarter at the end of last year, particularly for the U.S. market, which had its biggest gap, U.S. versus non-U.S. in many, many, many years. So, but then a switch flipped at the beginning of this year, or really, I would say on Inauguration Day. And we moved from this kind of unbridled enthusiasm, particularly for the U.S. market, to a lot more concern about the U.S. market. It started with, discussion of tariffs, and it continued with discussion of tariffs. Problem was the discussion was there every single day with a different talking point. And so, we started to see a little bit of uncertainty creep into this, previously very enthusiastic investment outlook. So we moved from enthusiasm to uncertainty. And then on April 2nd, I would say we had another switch that flipped to what I would call just confusion. It was, yes, uncertainty is okay in that you can assign probabilities to outcomes and then invest that way. But when you start to get confusion, and as you say, markets, are doing complete round trips in a day, it makes it much more difficult to invest. I've also seen, obviously a big decline in the dollar, and importantly, now we're seeing a period where the U.S. is far underperforming the rest of the world. And so I think, this discussion is particularly timely. We've seen, Europe far outperforming the U.S. We've seen it's not just a sector thing. We've seen almost every sector in Europe outperform the U.S. But all of that against a backdrop of really heightened volatility.
Yes, to put it mildly. We'll get to all the vol fun in a second, listeners. First, let's jump over to Matt. Matt, as our duly appointed European representative here today, at least for EUREX, give us also your thoughts on the impact of the tariffs on the European markets. And of course, there's some different moving parts in the European markets that some of our US-based listeners may not be familiar with, different indices, different benchmarks. Maybe give them a bit of an overview of how they should be looking at these markets and framing this conversation, Matt.
Yeah, I mean, on the back of what Melissa just said, it's almost like Liberation Day never happened over in Europe. I think it's good to kind of take a step back and look at, for the folks that aren't necessarily aware of what the main European indices are, kind of take a step back and kind of break those down. I would say the index sector over in Europe is much larger than it is in the United States. If you look at the US market, you have obviously S&P and NASDAQ are the two big ones. Russell 2000 less so, and let's face it, Dow is kind of dead at this point. If you look at the European markets, there's many more ways to slice and dice Europe. You have EUROSTOXX 50, which is really the premier index of Europe. That is kind of the 50 blue chip names within the European zone. There's really only, outside of the cash market, one way to trade futures and options, and that's on EUREX. You also have more broadly diversified ways of trading Europe. Stocks Europe 600 is one of the fastest growing products that we have right now on EUREX. That's a more broadly defined way of trading Europe that does not just look at the Eurozone, it looks at Europe as a whole. Similarly, there's MSCI Europe, which again is a more diverse way of looking at Europe. And then you have kind of the regional indices. I'm sure most people are aware of FTSE 100. FTSE 100 is kind of the 100 big names in the UK, which we all know is no longer part of the EU. And then you have the DAX, which is the S&P 500 of Germany. So kind of where are we now a couple of weeks after Liberation Day? DAX is up 20% year to date, right? It's basically back at an all-time high. It's as if April 2nd never happened. If you look at EUROSTOXX 50, up 10% year to date. You look at some of the more broadly diversified indices like Stocks Europe 600, MSCI Europe, they're up 7 and 8%. So, the markets really shrugged off a lot of that geopolitical risk. And I think they shrugged it off a lot quicker than the US markets did. I'm sure, we'll talk about VSTOXX a bit later. VSTOXX is the VIX of Europe. I mean, that went up to 45, 46, whereas VIX went up to 50, 55. And for the most part, VSTOXX traded at a discount to VIX for most of April, which was a bit interesting. I think if you looked at February and March, there was definitely this big overhang in Europe. What kind of tariffs is Trump going to put on the EU? You had Liberation Day, and then the markets seemed to kind of get past that relatively quickly. And markets, for the most part, if you look at DAX, you look at EUROSTOXX, we're kind of back to all-time highs. So, definitely seems like the European markets are outperforming. Let's see if we stay there.
That is the million-dollar question. And Matt, before we roll off, really quickly, you kind of touched on some of the different benchmarks, some of the different products that folks are looking at over there in the Eurozone. From your perspective, you've been looking at the US and the European markets for a little while now. What really stands out to you as in terms of key differences? Remember, a lot of people listening to this who are based in the US, this is maybe their first foray into the European derivatives market. What stands out to you really as some of the key differences?
Yeah, I would say there's two real big things. One is market structure is much different in Europe than it is in the United States. For a mom and pop investor and a retail investor, at the end of the day, things like clearing don't really matter. Or I shouldn't say don't matter. It's something that you don't really think about in the United States. If you trade options in the United States, your positions are going to clear at the OCC. You don't really care what exchange you trade on. It's really an afterthought for you if you think about it at all. In Europe, it's more fragmented in that where you clear, where you execute matters because there's competition between clearinghouses. There isn't one standard clearinghouse. So EUREX has a clearinghouse. Some of our competing exchanges have clearinghouses. So pretty much the whole gamut of investors need to be cognizant of one, where they're executing, and then where they're clearing. From an institutional standpoint, that obviously matters much more when it comes to things like cross-margining and ensuring that you're maximizing margin inefficiencies. Again, less so from a retail standpoint, but that does result in fragmentation of markets, and that's noticeable in liquidity between European and US markets. Second thing is, and I touched on this before, is I would say there's much more ways to kind of slice and dice Europe from an index standpoint than in the US. Again, the US benchmarks are unbelievably liquid. As we all know, S&P is one of the most liquid instruments in the world, but there's many more index products in Europe than there are in the US, right? So again, you have DAX, you have MSCI Europe, Stock 600, and then you have EuroSTOXX, obviously, and then you have the sectors. The sectors are something that, if you look in the US market, are really only popular in I would say an ETF or a cash index standpoint. The sectors are quite liquid from a futures and an option standpoint over in Europe. So EuroSTOXX, banks, insurance, real estate, you can all trade those in a listed futures and options format over in Europe on EUREX.
All right, Steve, last but not least, so we'll get to all the vol fun in a second, but obviously you're coming at this through the retail lens. It's been a wild start to the year, a wild month for most of the retail clients, especially some of the newer ones. I mean, most of the people who've been in this business have never seen anything like this, let alone people who've only been in the markets for a few years. So makes for an interesting frame of reference for them. What are your thoughts? Again, that same question, the overall impact of the tariffs on the European markets. And then what are you seeing as a response from your retail clients here in the U.S.?
Well, first of all, I think unintended motto of the current administration is make European markets great again, because that's really what happened as a result. I think, Matt and Melissa touched upon the outperformance of European markets vis-a-vis US markets. I guess Europe, there are always the concerns that the tariffs will bite into European US commerce, but not to this. Europe has really managed to escape the brunt of the potential tariff announcements. They're in there, but not, they don't seem to be the focus. But at the same time, I think, what we saw here in terms of US policies forced two things. Number one, I think European investors who had, like everybody else, were putting money into US stocks very aggressively, realized it might be time to repatriate. Second, I think US investors who essentially had the luxury of ignoring the rest of the world for the last couple of years, which I never think is a good thing. I started my careers in international equity arbitrage, so I've always looked at the rest of the world. But I think that for people chase out performance, people chase performance, and it was pretty clear that Europe was the basis of a lot of the global equity performance. The US is back to playing in the weird position now, playing catch up to Europe. So I think our customers, because we give them the ability to look globally and think globally, started to do so. Whereas I think a lot of our global customers were using our platform to look at the US. I think the recent political and tariff turmoil forced a lot of, not forced, but pushed a lot of investors to choose to use these opportunities that are available to them elsewhere. So I'm glad to be participating in this as a result, and help those who haven't yet figured it out start to look elsewhere when that it's not just US performance.
All right, let's get to the sexy stuff, the stuff that brought everyone to the dance today. Let's talk vol. Vol, again, the inescapable byproduct of all these political machinations, listeners. We're up, we're down, 50, 100, 150 points, sometimes in the span of a few minutes. What's a whole month's worth of range in a few hours amongst friends out there? So we've all experienced quite a bit of realized volatility in the market right now. And of course, implied volatility has reacted. We've seen wild swings in some of the listed vol products. We'll get to VIX. We'll get to VSTOXX in a second. If you've been listening, some of our other content, or many of you out there are trading other products, you've also realized that no asset class is safe right now. I mean, equities are obviously very wild right now, but FX, ags, metals, currencies, cryptocurrencies, you pick it. Chances are it's having a very wild run right now. So volatility has been the name of the game across the board, no matter what asset and no matter what markets you're playing in right now. Melissa, I want to start with you because you're bringing a little bit of a different perspective to the show here today. We're going to talk all the fun listed stuff of VSTOXX and VIX and everything else in a second, but you're bringing, like I said, a little bit of a different perspective. You have a more proprietary model approach to looking at volatility, your Axioma risk models. I'm sure a lot of our listeners are not familiar with that, so let's start there. What are the Axioma risk models, and then what are they telling us about the current vol environment?
So at their most basic form, the Axioma risk models use company characteristics and market characteristics to forecast volatility over some time period. It might be the next 1 to 2 months and the next 3 to 6 months. But the idea is we're taking a somewhat longer term view in general than, say, VIX or VSTOXX. And we're using characteristics of companies in order to drive that. So we look at, for example, different industries are going to have different volatilities, or different characteristics, like large stocks are going to have a different level of volatility than small stocks. And so we can take all those characteristics, apply it to a portfolio, and say what we expect the volatility of this portfolio, or we would do it on indices. We also do it on an active basis. So if your portfolio is different from the market, how much different volatility versus the market can we expect? And so that's a very quick thumbnail sketch of what our risk models are trying to do.
And what are they telling us right now?
So interestingly, in the period of uncertainty that I was talking about before, the risk models were relatively flat. We were looking kind of average levels of risk. On April 2nd, risk shot up across the globe. Your risk for stocks Europe 600 more than doubled over the course of 2 or 3 days. And when I say risk, that's our predicted volatility. So that's, not only has it gotten to not an all-time high, but, certainly high relative to where it's been for a number of years, but also that sudden increase in our predicted volatility, which is suggesting that every one of those underlying measures, whether it's industry volatility or style factor volatility or country volatility or currency volatility, all of those things have contributed to this huge increase in our expectations of volatility. And, that in and of itself sometimes scares people out of the market. Because, I don't know if I buy today, if I'm buying an index or whatever, if it's going to be down 2% tomorrow or up 2% tomorrow, it makes that decision that much more difficult. So that's kind of what we're talking about. And this is not just in Europe. This is kind of globally, we've seen this increase, and it hasn't really started to come down yet. It's inching down very, very slowly with what the market's done over the past few weeks. But, it certainly has been a scary time.
I like to call those the take your ball and go home markets, when things are just a little bit too spicy for your average retail, and certainly for a lot of your professional traders as well. They'll say, I'm going to wait until things settle down a little bit. From your perspective, Melissa, you've been crunching these numbers for a little while now. Have you ever seen any other market conditions quite like this, or do these stand alone?
Well, I am, you might be able to tell by the gray hair that I have lived through a few of these. This is, but nothing that's been driven by a trade war, nothing that's, self-inflicted like this, I would say. But we have seen periods where, you get this, shooting up of volatility, and it's always driven by different things. If you think of the global financial crisis, volatility went up, stayed up for a while, did kind of slowly trickle back down. But I would say I have seen this before, but again, just emphasize that, it is very different, the drivers this time, because we still have this confusion about what are tariffs going to be tomorrow or next week or 90 days from now that we haven't had in the past.
Yes, we've all seen vol, but nothing sprinkled with a little bit of a dash of trade war on top. Certainly adds a little bit of flavor, a little bit of context to what's going on. Before we keep going, I just want to remind everyone who took the time to join us live, you get a special bonus. If you do have questions, feel free to put them in the chat. We'll see if we can work them into the show for you, or maybe address them at the end. So it's just a little bit of a bonus for all of you folks who took time out of your busy day to join us live. All you folks after the fact, you'll be able to ask questions for future shows, but not today. Matt, we'll keep rolling out to you, sir. Obviously, a lot going on the listed vol side, in particular in the Eurozone. You mentioned VSTOXX earlier. Give us a quick overview. What are we talking about? What the heck is VSTOXX? And then what have you been seeing from a specific vol impact side from these tariffs?
Yeah, sure. So, for those listening that have listened to me on Volatility Views in the past, I'm sure you've heard this spiel. But VIX is very much, or VSTOXX is very much the cousin of VIX, right? So if you look at VIX tracks forward 30-day volatility on the S&P 500. VSTOXX tracks forward 30-day volatility on EUROSTOXX. So very similar products, slight nuances in how the indexes settle and some slight mechanics. But with that being said, for tracking purposes, very similar indices. VSTOXX by far is the most pure way to kind of play and hedge pure Eurozone risk. So, what have we been seeing over the last, let's say, 6 weeks? Some of the comments before have been spot on. I think really April 2nd, April 3rd, people kind of stepped back. I think there was a lot of retail investors that historically tried to buy the dip potentially got run over, especially on the short end of the EUROSTOXX curve. You started to see those folks kind of step back a little bit and try to reassess how to trade. We definitely saw that in VSTOXX options activity. Definitely slowed down. What do you do with VSTOXX when it's trading at 45? Is it going higher? Is it going lower? Nobody really had any idea. Liquidity was there. people just didn't necessarily know what to do. And I think we saw people really step back and de-risk wherever they could. The other theme that we definitely saw, and I know a number of other exchanges saw this as well, is I think traders realized you could reduce your positioning and still potentially have the same risk reward that you did before in a much higher volatility environment. So we're now starting to see some of that reverse again. We're starting to see position sizes pick up, really starting with this week. Just this morning, there was some chunky June 35 calls being bought. So somebody's taking a view that potentially there's some upside here in VSTOXX. VSTOXX today has a 17 handle, believe it or not. We also saw some people buying May 17 puts. So the market seems a little more balanced. Again, VSTOXX at 17. I don't know if that's the right price. It seems like the market is saying trade war over. Not sure that's correct. If you look at the term structure, October's got a 20 handle on it, but that's meaningfully lower than where we were just a week ago. So, the market has definitely repriced. It seems like the market has said this is done. Just my opinion, but I'm not sure that's the right call.
Yeah, I mentioned before the take your ball and go home markets. That's usually when VIX crosses over 30. That's when people start to sit up and take notice. And certainly when we get north of 35, especially if you're hanging out there for a little bit, those seem to be the take your ball and go home markets. Would you say it's a similar level for VSTOXX, Matt? Once you're getting north of 35, people are going to say, okay, I'm going to wait for a little bit of quieter markets to get back in.
Yeah, for sure. And again, we definitely saw that on the short end of the curve with EUROSTOXX options. I think people just had no idea how to trade a market that was moving 5% in a day. Again, the buy the dip guys seem to have disappeared. That trade definitely died in the first 2 weeks of April. Seems to be coming back now a little bit, but yeah, VIX and VSTOXX trade very much in line. If you look at the spread historically, it's within 2 vol points of each other. As I said earlier, it was interesting that VSTOXX traded at almost an 8 vol discount to VIX for most of April. So it seemed like the risk was in the US market, or at least that's how volatility indices were pricing risk. But yeah, generally the spread between VIX and VSTOXX is pretty tight. Above that 30-40 range, you start to see options activity die out pretty meaningfully.
All right, Steve, as our boots on the ground guy, you've been seeing how retail has actually been engaging with these wild markets. Obviously, things got a little spicy for a while. People probably taking that proverbial ball and going home. Things getting a little bit more manageable now. What were you seeing? Obviously, IB also the pretty much largest U.S. outlet for VSTOXX options over there. So did you see anything interesting or worthy of note on the VSTOXX side? And in general, what are your thoughts on this vol we've all been living through post-Liberation Day, Steve?
Well, I think, to expand upon Matt's points, I think what we saw, interestingly, we saw dip buying the entire way down. But remember, people, when things get dicey, they go back to what they feel most comfortable with. So U.S. investors feel most comfortable with the big cap tech stocks and the major U.S. indices. So that is where we saw a lot of the dip buying come in. I think, to a U.S. investor's point of view, VSTOXX and the like in your, foreign markets are there's an extra degree of risk in some ways because of currency. There's some other stuff going on from, that they may not be as exposed to. So people stick to their knitting and say, it may be harder to say, VSTOXX at 32 seems like a sale, but NVIDIA at 99, I know that's a buy. And that was kind of the mentality we saw. I think one of the ways that it becomes very useful is to compare VIX to VSTOXX. That's one of the ways I look at it. VSTOXX, interestingly, is a smaller index. So you might think that it should be more volatile because it's 50 stocks as opposed to 500 stocks. And therefore it would be easier for them to correlate, easier for the index to move because, the more correlation you have within an index, the more volatility you have. Think about it. If everything's moving in the same direction, the index is volatile. If everything's moving in different directions, that dampens volatility. But in general, I think that's more because of just the structural nature of the components and to some extent the level of speculation of the participants in different regions. Again, now we're starting to see both of these indices, no matter what, pick your volatility index, domestic or international, they've all come off dramatically. So right now with VSTOXX, essentially, just peeking over my screen, it says, again, as Matt mentioned, a 17 handle. So, that's implying basically 1 day top to bottom, high, low volatility for the coming 30 days. Maybe you could say that in Europe, but in the US where you have call it an 18 VIX, but yet we move seemingly 1%, 2%, 3% every day. I'm going to say that might be expressing a little bit of complacency. So, these are the type of things you may want to consider. I think it's very interesting to consider the relationship between VIX and VSTOXX and almost, sort of trade the spread there to some extent, but it is interesting that at least over the last year, VSTOXX for the most part has been a lower number than VIX, even though they measure essentially the same sort of thing.
And Steve, IB obviously speaks to a more active demographic, a pro-tail. I don't really like that term, but a pro-tail customer, if you will. Did you see that same, especially a few weeks ago when things were really spicy, VIX, VSTOXX, both north of 30? Did you see that same cessation of activity, or were the IB folks still trading in and out?
The most active traders, the pro-tail ones, so to speak, and I think I mentioned this at OIC. I think I'm contractually obligated to footnote our friend Henry Schwartz every time I use the term, because I think he came up with that one. But those people trade day in, day out, no matter what, and that's kind of the reason why we append the word pro to some of them. They are there, come hell or high water, and trading their favorite names. So they were as aggressive, if not more so, because volatility brings trading opportunities during that move. Obviously, some of our less active customers, some of our more pure retail, or even some of our less active institutional customers took a step back and said, it's very hard to navigate this volatility. It really pointed out the difference in approaches, because some traders ran to this, others ran, I would say the most active traders ran to the volatility, more sedate investors shied away from it.
They ran into the fire. They're those crazy folks who listen to our vol views with us every week. Yep. Well, we're getting to the most difficult, some might say the most dangerous part of this show, listeners, which is the attempt we all have to look forward a little bit. Now, we all know in these markets, things can change on a tweet. We saw over the weekend. That's all it took. So, yes, we're in very wild times, very difficult to come to grips with from an outlook perspective, but we're going to try nonetheless here on the inaugural episode of the European Market Brief. Melissa, we'll start with you again. A lot going on, a lot to come to grips with in terms of modeling and projecting out there. But in light of everything we just talked about, the vol, the movement, the political dynamics, the economic dynamics, is there anything on the European side of the pond that you're really focused on? Maybe some indices, some products that you think people should be watching going forward? And keep in mind, there's a lot of listeners to this who are based in the U.S. who are maybe thinking about taking their first foray into the European market. So any thoughts or any advice for them?
Yeah, well, I think given the turmoil and, talking about these differences between VIX and VSTOXX, or, for many other reasons, I think we're starting to see the European market look a lot more appealing than it has for a long time. I think we've seen, for example, on the defense stock side, where, Europeans are maybe thinking that, the U.S. isn't going to come to their aid as much as they might have expected to in the past. So they need to reinvest in defense. They need to reinvest more in themselves, maybe. So, we might expect financial stocks to start to do better as well. But I think in general, until we see some of this volatility subside, my recommendation is to be well diversified. European markets certainly look attractive. They've moved up, but if you look over a longer time frame, they're well below what's happened in the US market. So I think there's plenty of room for Europe to move back up, but I would still want to be relatively well diversified, get some of that correlation out of there. You don't want, if you just buy one sector, you're kind of stuck with stocks that are going to be correlated with each other and therefore potentially more volatile. So I would look to the Europe 600 or, so kind of broadly across Europe, not just choosing one country or necessarily choosing one sector, but just remaining as diversified as you can be, at least in the near term.
All right, Melissa, I'm going to ask you the $1 million question. So prepare yourself. We obviously saw maybe a bit of a white flag this weekend, a bit of a détente between the two biggest antagonists in this trade war, U.S. and China. The devil is in the details, and it sounds like the details are still being worked out. Nonetheless, didn't stop everyone from taking a victory lap. Markets certainly liked it yesterday. Big rally yesterday. Vol coming crashing back to earth. So I have to ask you, Melissa, in light of that, is this it? Trade war over? Or is this just maybe the pause before the next leg up in vol?
Well, I would have to say if they hadn't said something about, well, we're going to do this for 90 days, then, you maybe could have had a little more assurance that maybe trade wars were coming down. But I do think that and I haven't, kind of read the details of everything that's been agreed, but it does seem like that the U.S. is willing to pull back to maybe having tariffs that are a little bit higher than they used to be, but the threat of very high tariffs driving very high inflation and, keeping growth down, maybe that has gone away because the U.S. has signaled a willingness to not impose these huge tariffs. But again, 90 days from now, maybe we'll see something different. But I think for right now, they're not over, but they've abated somewhat.
Mr. Matt, same question for you, sir. Looking forward, again, these are challenging times to do anything beyond a couple hours, but we're going to look a little bit farther afield than that. Looking across the pond at the European markets, the European indexes, all the products you just discussed. Are there any that you think people should be focusing on, and also some key factors to keep an eye on for a lot of our U.S.-based listeners who are maybe turning towards these markets for the first time?
Yeah, I mean, to Melissa's point, I think it's spot on to say you need to be diversified in this market. Looking at the broader based indices is the way to go. Again, EUROSTOXX 50, Stocks Europe 600, those are all tradable from the U.S. Any EUREX product that is CFTC approved can be traded by retail. We quite literally have hundreds of them. It's really just a matter of whether or not your broker offers them. So I think really the moral of the story is to be diversified heading into the next couple months. As for your question, is the trade war over? Again, just my opinion, but we're only 5 months into this new presidency. We have 3.5 years of this, maybe even another term, depending on who you ask. I think it's very likely you'll see a resurgence in volatility again. And that's something that investors need to make sure they position themselves for. What I think is important for this call and for anybody that's listening, if you have any interest in Europe, make sure you have a broker that offers European products, whether they be futures, options, cash, what have you. We are broker agnostic, but our partners at Interactive Brokers do a fantastic job of offering really a large chunk of our futures and options products. If you want to trade the VIX VSTOXX spread, like Steve was pointing out, there are a few brokers that allow you to do that, like Interactive Brokers. So for anybody on the call, definitely make sure you have an account set up for when the next opportunity presents itself.
Matt dropping the bomb of a third term. We won't go that far afield just yet. Mr. Steve, though, same questions for you. Again, looking across the pond at the European markets, what are areas you think that are worthy of note? Maybe some interesting opportunities for your retail/pro-tail customers. And again, a lot of them might be new to the European markets as well. So some interesting things to keep an eye out for, sir.
Well, first of all, I have to thank Matt. I couldn't have said it better myself. So thank you very much, coming from a respected partner of ours. I think I don't want to sound like I'm echoing the Melissa and Matt too much, but I do think diversification proved its worth this year. we've gotten spoiled, in the US. We didn't have to diversify. And I did a panel with a friend, just sort of for one of the local charitable organizations here. He's a local financial planner, and it was earlier in the year, and he was almost poo-pooing diversification. This was probably I think it was January before the inauguration. It was early, and he's like, well, why would I need to look anywhere besides the U.S.? All my money's in dollars. My investments are in dollars, is what I know. U.S. is outperforming. And I said, that kind of works until it doesn't. I didn't really expect, Monty Python fans. I'm thinking here, you didn't expect the Spanish Inquisition, but this was this was exactly why you do diversify, why you do put a certain amount, of your assets in other places rather than just, the stuff, because when a trade gets too crowded, it gets very difficult when people run for the exits. The other thing I do want to remind people is, what we're seeing now is socially acceptable volatility, but it's volatility nonetheless. All right, I'm looking over at my screen. The SPOOs are up just under 1% right now. That's volatility, right? I mean, we like it because most of us trade from the long side. Most of us have investments, 401ks, et cetera. So people like it when it goes up 1%. People love it when it goes up 3%. That's volatility. Remember, we went for months, if not years, without 2% moves, and now they come fairly routinely. So I do think right now, a very opportune time to do one of my favorite strategies, which is don't fight the tape, but insure against it. And that is saying, no matter where you want to put your assets, maybe you don't want to stand in the way of this momentum run, because the momentum train has left the station and is speeding along down the track here. So you don't necessarily want to fight that. But we're getting a little bit of a gift when I see major volatility measures back to the low to mid to high teens, whether it's VSTOXX, whether it's VIX, et cetera. Yet we're still seeing these big moves. And so, I think that puts us out here. And I think that goes to Melissa's points about balancing your risk. And I think, that's one of the reasons I'm glad to be having this opportunity to talk today, because, some of the, even within Europe, as Melissa mentioned, you've had defense stocks get what I would say is a bit stretched. But on the other hand, there doesn't seem to be this flight into the dollar all the time. And remember, if you're a US investor buying stocks in Europe, you are inherently exposed to the euro. And I would say that's probably a good thing right now, considering we still, that yes, there seems to be a ceasefire in the trade war. I'm going to argue the market has decided that the 90-day moratoria probably don't matter, and I'm kind of along that mindset now. It just, I think, as long as people make a show of talking about trade talks, they'll get their 90 days extended. But we're going to have some very difficult budgetary questions here in the U.S. I do think, to some extent, I think it was Mark Rowan who said it, but I apologize here, but it was like, U.S. exceptionalism is not dead, but maybe we're not quite as exceptional as we thought we were. And if that's the case, that's when you have to start looking abroad, if you haven't been doing so already. And so I do think diversification among industries is always important. Diversification around the globe is probably more important now than it's been in a long time.
All right, that music means we've come to the end of this inaugural episode of the European Market Brief. I want to thank all of you who joined us live, all of you who are joining after the fact. We love you all too. It's going to be a lot more coming down the pack from this show in future episodes. We're going to have additional segments like the overnight desk, where we'll be talking about specific activity that caught our eye out there in the markets. We'll also have the red phone, the infamous red phone, where you can handle some of your questions about these crazy markets that are out there right now. It just seemed for this first episode, tariffs are inescapable. They are unavoidable. So they had to be the focal point of the first episode. And we will come back to continental conversations in future episodes as well, when we find interesting topics that are worthy of taking a deep dive into. But before we go, let's go around the horn. Melissa, you did a great job for your first time here on the network. Before we go, if folks are intrigued by SimCorp, maybe let's check out your Axioma risk models. Where should they go? What should they do?
www.simcorp.com, and look under resources, and you'll find all sorts of market commentary about, global markets, US markets, European markets. Yeah, we've got a lot of stuff on our website.
There you go. Check them out. SimCorp, SIMCORP. the place to go to kick the tires and light the fires. Steve, same question for you. If they somehow aren't familiar with how to find IB, tell them where to go, and then what can they do once they get there, sir? You're adding new content all the time.
IBKR.com is certainly the place to go. IBKR Campus is a very good place to start because that's really where we put our educational resources in one place. Trader's Insight, where I write theoretically daily. I don't know if I'm going to get around to it because I was doing this podcast this morning that kind of interrupted my writing time. So, but I tend to put stuff on there most days under the Trader's Insight banner, and you can subscribe to that stuff for free. All our resources are free. And so, I think it's a great place to get started for people with strategies and how to manage your risks. We're not doing it necessarily at the big portfolio level that Melissa is, but I think from there are portfolio risk tools. And I think just in terms of option strategies and ways to understand the market, there's a lot of content on there.
And last but not least, Matt, if folks want to learn more about VSTOXX or just some of the EUREX indexes in general, where should they go? What should they do?
Best place is the EUREX website, EUREX.com. There's literally thousands of pages on there, contract specs, liquidity stats, you name it. It's on the EUREX website. People can always reach out to me directly, reach out to you, reach out to your broker. Always happy to help.
There you go. Check them out. EUREX.com, EUREX.com, the place to go to kick the tires and light the fires. That is going to do it for this inaugural episode of the European Market Brief. Hope you had a good time. We had a good time bringing it to you. That's going to do it for us on the network today as well. Back again tomorrow with our usual doubleheader of the options bootcamp as well as the futures rundown. Friday, of course, we have the option block and This Week in Futures Options. Thursday, the option block and This Week in Futures Options. Friday, volatility views for all of you who like a little bit of vol. We have talked VSTOXX on that show in the past, probably get to it again in the future. You want to check out volatility views. And for all of you who want even more in your lives and who also, you like this live thing, you want to join us for the live shows like Pro Q&As and, of course, Options Oddities, where we talk a lot of unusual activity. Only one place to go to get all that, theoptionsinsider.com/pro. Then we'll be back again, not that far down the road, with another episode of the European Market Brief. Stay safe out there.